All right. Good morning, everyone. Welcome to the New York City Fire Pension Fund Investment Meeting. We are at One Battery Plaza on the 9th floor in the conference room. This is a hybrid meeting with some attendees attending virtually via Zoom. Today is March 18th, 2024. It is 9:41 a.m. I will turn it over to Mr. Dunn for a roll call.
Good morning, all. For Mayor Adams.
Kevin Liu, present.
Okay. For Controller Lander.
John Dorsett, designee for Controller Brad Lander.
Okay. For Finance, Commissioner Nyblock.
She's here, but she's step out.
Do you want to take a proxy for this
I'll take a
moment?
proxy for her, present.
Okay. And for the UFA, Mr. Ansbro.
Bobby Eustace for the Andrew Andrews proxy.
Okay. Mr. Eustace.
Present.
Mr. Viola.
Present.
Okay. Mr. Tvetter.
Bobby Eustace with Dennis DeVetta's proxy.
Okay. And Mr. John Young.
John Young, present.
Okay. For the UFOA, Mr. Camastro. Mr. Guilfoyle.
Here.
Mr. Michael. And Commissioner, for Commissioner Kavanaugh,
Lizette Kristoff here.
we have a quorum.
Excellent. Thank you. I will turn it over to the controller. Agenda.
Great, thank you very much. So we have just two items in the public agenda today. One is a quarterly report delivered by Steve Meyer in the Bureau of Asset Management, and the other is a risk presentation. So Steve, I see that you're on via Zoom. I just want to point out Steve is taking time out of his vacation to his well-deserved vacation to speak to us this morning. Steve, just so you know, we're under a slight time constraint this morning. We need to finish at an earlier than anticipated time. So we'd ask that you provide us a concise quarterly report.
Okay, John, thanks. That sounds good. I'll try to keep it brief and I'll skip some slides. As long as Kate can keep up with me, we should be in good shape. Well, good morning, trustees. I'm sorry I couldn't be there in person, but I'm glad to be with you virtually. Before we get started on the quarterly review, I'd like to just remind ourselves that we're long-term investors, and there are a number of trends that we believe will impact the portfolio's performance over the next 10 years. Those trends, and I'll just go through them quickly, are decarbonization or climate change, which I do think will have a profound impact on opportunities over time. Shifting demographics, both here and abroad, and the impact on labor force dynamics. Deglobalization, perhaps pulling some of the manufacturing base away from China.
Steve, if you could hold on 1 second, you're coming in very muted, so trying to raise your volume on this end.
Got it. I'm as high as I go here. Is it more helpful if I'm closer?
I think we're raising the volume on television and see if that helps.
Got it. Great. Thanks, Liam.
Steve, you can start talking. We'll let you know if we have something else.
Sure. Is that better? I'll speak loudly. How's that? Sorry. Well, I talked about decarbonization, demographic changes, and deglobalization, the onshoring, nearshoring, and friendshoring of supply chain robustness. Also, I look at sovereign debt as one of the key drivers of potential performance over time. And the levels of sovereign debt, both here and abroad, are very high. And I'll show you a couple slides on that as we go through our presentation. But the takeaway for me would be that a higher level of outstanding debt in terms of U.S. debt, increased deficits, increased supply coming into the marketplace, a more yield-sensitive buying base as opposed to yield-insensitive buying base, to me will translate into higher base rates and more meaningful returns for fixed income for the portfolio over the coming years. Next, an altered geopolitical condition. We see obviously significant impacts on geopolitical developments around the world, impacts on global trade, defense spending, trading alliances, and the like. And last but not least, transformational technologies. Here we're talking about artificial intelligence, which I do believe will have a profound impact on the economy, on our lives, and on our investable asset base over the course of time. We look at these 6 trends to get a sense for what's the impact on global and domestic economic growth, inflation, productivity, public spending, and private investment. So with that, Kate, if we can go to the first slide. Thanks, Kate. So the clear trend here and abroad is for lower levels of inflation. The disinflationary trends are well intact, and we're seeing the benefits associated with central bank tightening in the last year. On the next page, just a look at what that appears to be. You can see in the white on the upper right-hand side, the spike inflation CPI was over 9% in the middle part of 2022. It's actually come down quite nicely. If you notice, the decline, though, is stalled a little bit. I'm sorry. Okay. It stalled a little bit. And you can see that the last mile is going to be a little more challenging for the Fed. Not having said that, you still have inflation below 3%. And more recently, the core PCE deflator, the Fed's preferred measure, is just under 3%. We get another reading of that on March 29th, which everyone's waiting and looking forward to. On the next slide, just a quick look at inflation around the world, and you can see that in those big banks, U.S., Eurozone, and the Bank of England, the U.K., rates went up, inflation went up with them, and obviously came down accordingly. This is a 20-year chart. What I think is really interesting here as well is how long you had inflation post-global financial crisis, stuck between 0 and 2%, so fairly well behaved for an extended period of time. And then again, that spike and some stickiness in terms of where we are on the far right-hand side. On the next slide, a look at employment. U.S. employment has been incredibly resilient and has contributed to a resilient U.S. economy. And the question here is, will the Fed be successful in achieving that soft landing that everyone speaks about today? On the next slide, a look at the unemployment rate. This is a little bit, well, actually, I take it back. My slide is a little dated. Dan's is up to date. So unemployment for February came in at 3.9%. You can see that the labor force participation rate in yellow up top is still about 1 percentage point below where it was pre-pandemic. That has to do a lot with people retiring and not coming back to work following the disruptions of the pandemic. On the next slide, as I said, economic growth here and abroad has held up very well, which has surprised many economists given the dramatic increase in official rates in 2022 and 2023. The exception here is Japan. Japan hasn't changed their interest rates in 2016, and they haven't raised official interest rates since 2007, so almost 18 years since they've raised rates. But what we're reading about and hearing about is that a rate hike in Japan is perhaps imminent. On the next slide, on the far right-hand side, you look at the green and the red. This is the red is the U.S. economy and the annualized GDP for the U.S. And in green, again, China. China has undertaken an ambitious 5% target for 2024, which will be a challenge, and it is ambitious for them for a number of reasons. China continues to deal with and suffer under a property market slump. They're experiencing deflation, not disinflation, not a decline in the rate of inflation, but actually a decline in price levels. Demographic shifts there as well. They've got an aging population, very low birth rates, an over-leveraged shadow banking system that's less regulated. And lastly, declining exports as some of the economies of the West pull back and again, focus more on supply chain robustness and onshoring or nearshoring. On the next slide, a look at Fed official interest rates. At one point this year, the market was pricing in fully 7 interest rate cuts for 2024 versus the Fed's estimate of 3 or perhaps just 2. The market has come around to the Fed's thinking more recently with the robustness of the economy, the strength of employment, and the stickiness of inflation. The market is now pricing in just slightly over 2 rate hikes for this year. Again, this is a Fed meeting week, so on Wednesday, the 20th, we'll actually receive updated summary of economic projections or dot plots from the Fed, and everyone's waiting to see do they still expect to see potentially 3 rate cuts in 2024 or 2 or 1. So we'll keep watching that. On the next slide, here you can see it's a familiar slide. The top 3 U.S. Bank of England and ECB rates have been really on hold since the second half of 2023. Again, I mentioned that the outlier there is the Bank of Japan. Again, the market awaits to see whether they will hike rates at some point. On the next slide, worth noting where we are in the U.S. So obviously, credit spreads in the U.S. and high yield investment grade and private credit spreads have actually tightened quite significantly, and I think the market is pricing a soft landing. U.S. Treasury 10-year yields have been all over the place. So in 2023, as a reminder, they started the year at 3.89% yield. They ended the year exactly at 3.89% yield, but had traded as low as 3.30 or 3.30 in yield and as high as 5%. Today, they're around 4.3%. Again, slightly higher base rates, helping to provide some level of income for the portfolios. On the next slide, the inverted yield curve. So this is the longest inverted yield curve we've had on record. Not the deepest, but the longest. The deepest was actually in 80-81, where the yield curve was inverted by 190 basis points, but still indicating that the market anticipates an economic slowdown in the Fed or decline in inflation in the Fed to start reducing rates. So we have a more normally sloped yield curve with long rates being higher than short rates. On the next slide, just in terms of where we are today, in white up top, you can see that's the 2-year Treasury yields right now. This is a little stale because it was generated on Thursday last week. 2-year yields right now are in the 470s, 10s in green, actually as high as 430 this morning. So again, some volatility there, but again, still longer term rates are below short-term rates, again, reflective of that inverted yield curve. On the next slide, a quick look at credit spread. So this is actually a 10-year average credit spread. And you can see that in the upper portion where it's in orange, that straight line all the way across, that's the average spread, slightly over 400 basis points. We're about 380 basis points now, so not necessarily compelling. And investment grade in white on the bottom, same circumstance, where you can see that rates or spreads, I should say, are below where they have been on average over the last 10 years. This is probably more due to absolute yields being higher. So for fixed rates, if you're trading off of, say, the 10-year Treasury at 430, the spread above that is going to generate a yield of 7 to 8%. And if it's a floating rate obligation, you've got short rates, or 3-month SOFR this morning is 533. So a spread above that generates, absolute yields that are quite attractive for investors, pension funds as well, 7, 8, 9%. On the next slide, just in terms of where we are, so you can see it's very prominent. Bonds are back, base yield rates are higher, and helping to, again, deliver yield and income for the portfolios. And stock prices right now are very close to record highs. On the next slide, just a look at where we came out in the fourth quarter public markets. You can see in the middle portion, fourth quarter returns. So the Russell 3000 alone was up 12.1% just in that quarter. Developed market ex-US 10.5, emerging market equities 7.9%, which is a nice recovery off of a challenging period of time. And then below that, you can see even yields, but bonds have performed strongly with obviously returns much higher in investment grade and high yield, which is, I think, a good outcome there, and reflective of, again, tightening of credit spreads. On the next slide, look at equity markets. Most developed market indices are higher. As I said, year to date, again, this is more recently through last week, the Russell 3000 is up 7% alone. The strongest performer I wanted to note here is year to date, it is the Nikkei. The Japanese stock market is up in local dollar to local currency or yen terms, up 15.63%, which is a great outcome. That index just surpassed its all-time high, last reached in 1989. Another reason why we diversify, another reason why we don't put all of our money in public market equities, for example. Again, the Japanese Nikkei hit a record high in 1989, and it took 34 years for the market to get back to that level. On the next slide, I'll look at world bond markets. Again, as I mentioned, U.S. Treasury 10-year yields are significantly higher, reflecting a global resilient economy. Two exceptions here worth noting, Italy, where yields are actually down 10 basis points. And that's reflective of, believe it or not, the Italian economy outperforming the German economy and some tightening of the relative relationship there. And at the bottom, you can see China is down about 22 basis points year to date. Again, that's indicative of a sluggish economy and expectation for declines in rates there. Let's skip ahead one slide, Kate. One more slide, please. Yep. This is just a reminder of why diversification matters, why we don't try to time the markets. And I'll continue to bring this back to you on an annual basis, but this is the Callen periodic table of investment returns. It's something I'd like to look at as a reminder, again, just how volatile rates and markets can be in terms of return expectations. And again, this really speaks to the fact that diversification matters. And I encourage you to spend time, if you have this and convene, to go through it and just process it a little bit more when you have time. On the next slide, in terms of recent news, again, I mentioned earlier, a resilient U.S. economy has some prominent economists questioning when and if the Fed's going to hike rates this year. On our thought leadership speaker series recently, within the last, say, 6 weeks, we had Thorsten Slock from Apollo. He actually came out with a proclamation 2 weeks ago indicating he doesn't think you'll see any rate hikes in 2024. You've also had the former U.S. Treasury Secretary Larry Summers come out earlier this year and suggest that there's not a zero potential for the Fed's next official rate change to be a hike. And he attached at that time, I think, a 15% probability of that occurring. Also, more recently, you've had Minneapolis Fed Chair Neel Kashkari coming out and saying he expects to see only 1 or 2 rate cuts this year. The next slide, food for thought, just a look at U.S. and non-U.S. government debt and how it's actually increased across most developed markets between 2010 in green and 2023 in blue. The only exception there is Germany, where you've actually seen their debt level come down. This is general government debt, not public debt. But again, record deficits are being incurred around the world. The U.S. is certainly in that camp as well.
Steve, just out of curiosity,
Yeah.
from your perspective, when does that debt become a problem that we can't turn back from? When does it affect the markets negatively, or is there any way to predict that?
You know, I don't know if there's a clean way of predicting it, but my sense, Liam, is that it's impacting the markets now. That I do see that there is some level of certainly volatility, but resiliency in terms of base rates and tens. Again, trading in around 430. We continue to run record deficits, and irrespective of who the next president is, we can say with some level of certainty that we're going to continue to ratchet up our public debt. Our public debt right now is almost 98% of annual GDP. That 100% is historically considered a crossing point. If you look at the government's own expectation of our outstanding public debt relative to GDP, by 2034, they expect to see it go up to 116%. So I think we're there now, Liam. And I think you also, as you see, I've got a slide I'll touch on in a moment, but foreign buyers typically are less yield sensitive. And again, they're recycling money because of exports. They're buying fewer and fewer of our treasuries. More of our treasuries are being bought by domestic pension funds, investors, and household accounts. They're more yield sensitive. So they're not going to continue to buy when rates just continue to plunge. So I do think you'll see some resiliency, some stickiness in higher base rates, both on floating and fixed. And I think as an investor, from an investor's perspective, it's not necessarily unhealthy. But for the U.S. economy, I think longer term in the U.S. government, it's going to be a challenge because they got to roll debt. Or we pay right now over $870 billion in just interest rate expense a year. We have one of the largest deficits at $1.7 trillion. And it's becoming more of a challenge.
Would you? And we always talk about cracks in the economy. Would you consider what you're seeing the first signs of cracks based on the debt level?
I do. I think that's one of the trends. When I talked earlier about those 6 trends that I think will impact the markets and the economy longer term, I think it's sovereign debt levels, both here and abroad. I think it's going to be increasingly scrutinized. we've got to get our deficits under control.
Thank you.
Sure, thanks. Kate, let's maybe skip ahead a couple of slides to keep it on track. Slide 24, Kate. One more, please. Yeah, that's just something I touched on earlier in terms of the foreign holdings of U.S. Treasury securities. And you can see that it used to be a higher 35%. Our largest single owner of U.S. Government debt is Japan, but they pulled back a little bit as their rates have started to move higher there as well. Their official rates haven't. They've reduced their yield curve controls a little bit, which means higher 10-year yields there, so more domestic demand in that domestic bond market. And again, this is another reason why I think it's going to be challenging the Fed to continue to roll its debt at some point. And again, it's the marginal buyer and what price they'll accept.
Steve, out of curiosity, historically, you had said previously that one of the first concerns would be if the U.S. were to put out treasuries to be bought and they weren't bought, that would be initially like the first time you see people not buying
A
it.
failed auction. Yep.
Was there ever a time that happened in the history of the U.S.?
No, not that I'm aware of. You have fat tails where they come in where the yields are higher than expected, but typically we've had primary dealers that have been able to take down product. Primary dealers now, a lot of them are owned by banks. They have restrictions in terms of how much debt they can take on, and they have generally a preference to own corporate debt because the returns they can earn on corporates are higher than what they're typically getting paid for positioning in treasuries. So we haven't had that circumstance yet, but rates are high and rates are expected to come lower, and I think that's helping the demand stabilize right now. What I worry about is if rates are cut, that they become less attractive to the marginal buyer, and then again we have the potential for a failed auction. I think that's a low probability event, Liam, but it's certainly something that would get everyone's attention.
So I just want to remind folks that when we get into executive session, we're going to have a deeper dive into fixed income. So some of these comments may be revisited in executive session.
Yeah, good point, John. Thanks. Let's see on slide 26, food for thought. Again, the rise and fall of AI in terms of the artificial intelligence halo on stock prices seemed to elevate a number of stocks last year. I recently had a meeting with a very senior person, a chief information officer or head of IT at one of the more prominent private equity firms. And I asked him, does he think artificial intelligence is real, and the timing and the run of parallel of that between artificial intelligence and the internet bubble we saw in 2000. And he did say, although some of the pricing has gotten probably to elevated and unhealthy levels, he likened artificial intelligence to when the Titan Prometheus stole fire from Olympus and gave it to man. He said it is going to be that significant in terms of how it impacts economies and corporations, and we're already starting to see the impact of that. And this is just a slide that looks at 12-month forward PEs, and you can see it in 2024 they're a little bit high, and certainly paralleling what we saw in 2000.
Steve, that was also the advent of the fire department, because somebody had to contain that function. So,
Thank you, John.
Very fitting analogy today. Thank you.
Thank you. I was hoping someone would pick up on that. Let's see. I know we're short on time, so maybe skip ahead. Skip ahead to 28, if you would, Kate. One more slide. This is actually an interesting slide. Again, food for thought. It really, I think, speaks to private equity, and perhaps is private equity a better business model? This is over the past 28 years. And you can see that the number of public companies in the U.S. has actually declined from over 8,000 to just below 4,400. And again, a lot of those companies are private. I know we had the privilege of having Robert Smith from Vista address us through our Thought Leadership Speaker Series a couple weeks ago. And I thought one of the most remarkable comments he made was that of software companies, 97% are private versus public. Again, they tend to be smaller, but just interesting in terms of the changing dynamics between public and private markets. And again, I think your strategic asset allocation with an increased allocation of private certainly reflects that change, and hopefully takes advantage of that over time. maybe jump to performance reporting for the fourth quarter and for 2023 calendar year. You can see, and Dan's been hard at work trying to put together new slides and more visuals. But again, we're supposed to focus on longer term returns, not necessarily 3 months or 1 year. But this just gives you an indication of where you came out in the fourth quarter of 2023. On the far left-hand side, you can see in red, again, fire red. The 3-month return for the plan was 6.9%. The policy return, assuming you were actually at your policy, you're not, although just coincidentally, it's 6.9% return for the public markets. For your total plan. The 65-35 indicates that the private markets have underperformed public markets this year, with that public market equivalent 65-35 outperforming by 300 basis points. And lastly, the median TUX performance, they tend to have a higher allocation to private markets, again, pulling down those returns a little bit. On the next slide, just a different way of looking at your 7% target, your actuarially assumed rate of return. And it's good news that the portfolio value over the last 10 years exceeds that 7% return at the margin up on the upper right-hand side. And it's just a compounding of returns at 7%. On the next slide, I'll look at FIRE's net public market returns by strategy. And here I think the good news and the takeaway here is there's a lot of green in the screen. Again, most of it's short. More importantly, 5 years, it's all green as well. 3 years is an indication of, well, emerging market equities have had some struggles and challenges, primarily due to China's slowing economy and the conditions that they have there. And also anything with duration attached to it, again, given the sell-off in bonds that occurred in 2022. Although we saw rallies in 2023 from extreme levels, they're still down from where they were, meaning in price and yields are higher. And you can see that core fixed income and treasury inflation protected securities and our economically targeted investments, again, because of the duration exposure there. On the next slide, a look at public markets net excess returns. And here you can see that there's been a little bit more red generated on the screen more recently. And again, I think that has to do with just the strong performance of the passive index benchmark. So again, Russell 3000, the excess return that we've generated is negative 22 basis points. But longer term, it's had flashes of more positive outcomes. And as I said, anything towards the bottom part of that page, fixed income has been a little bit more challenged because of the backup in rates, base rates. On the next slide, we're trying to provide a little bit more insight. So this is a slide that Dan Haas has worked on putting together. We'd like to continue to show this on a quarterly basis. These are the public market fees that FIRE has paid for the fourth quarter of the year. And you can see how they're broken down. Again, the differences here are oftentimes driven largely by, let's pick on U.S. equities. The fees there are 8 basis points on average because there's a high allocation of about 70% in passive, where we tend to be a little bit more active in developed market ex-US and certainly emerging market equities, as well as high yield is 100% active as well. But just an indication of where your fees are being paid. If you simply just multiply that by 4 times, it's about slightly under $20 million a year in public market fees. I do think we do an excellent job as a business unit negotiating lower and lower fees. I think we do a very poor job of communicating exactly what we're doing in that space to the trustees. So we are endeavoring to provide, again, much more insight into this critical issue of public fees as well as private over time. On the next slide, just a look at your private manager returns. Again, pretty positive in 1 year with the exception of real estate. I'd say real estate, core and non-core have struggled a little bit, mostly in the core space due to exposure to just general exposure of that sector to commercial and retail real estate. I'm sorry, when I say commercial, I mean office and retail real estate, it's all commercial. But as a general matter, when you look out 3, 5, 10 years since its inception, the private manager returns are actually quite strong. On the next slide, just to look at your relative performance. Again, looking at 3, 5, 10, and since inception, the yields are actually really quite significant. little bit more challenging in the short end. As I mentioned, let's pick on private equity underperforming its public market benchmark of the Russell 3000 by 1,560 basis points. That occurred in a year where you had a 26% return or rebound in the Russell 3000 in 2023. And there's a difference, there's some nuances in reporting in terms of private markets tend to report with a lag. The mark-to-markets aren't as current as public markets. So it's not as bad a story as it seems, certainly in the 1 year space. But if you look at 10-year returns, again, the excess yield returns you've been able to earn in private assets are significant and meaningful in the portfolio context. On the next slide, another new slide, and then I'm going to turn it over to Ed to run through his risk analysis. This is a new slide that we put together trying to reflect of where you are in terms of private market allocation. So in the middle, you see assets under management. This is actually the money you have in the ground. So pick on private equity at $1.817 billion. That's how much your portfolio is currently invested in. You also have a number of unfunded commitments that have yet to be called, that you've already approved and vetted, and that will be drawn down over time, of a little more than $1.117 billion. So again, your total exposure, not in your portfolio net yet today, but your total commitments, funded and unfunded, are $2.9 billion in private equity. And again, this is reflective of the hard work that the trustees have done in terms of evaluating and improving deals in the private equity, core and non-core real estate, infrastructure, and opportunistic fixed income. And with that, I'll open up to any questions. I know I've kind of thrown a lot at you, but again, process this slide a little bit. We think that there's obviously going to be more as you've increased your allocation to private markets. There'll be more deals coming down the pike, and again, these unfunded positions will be drawn down through a pacing plan over time, and through the normal calls.
Liam, you have a question? Okay. All right. So I think that concludes Steve's comments.
It does, John. Yeah.
I'll just remind folks that if you have questions between this meeting and the next scheduled meeting, feel free to reach out. And Steve is available. The team is available too. And we're always happy to address any questions or concerns. If you see something in the news, if we don't get to it first, which we try to get ahead of those things, we've probably already had a conversation and bam, we just haven't communicated with trustees, but we are on top of stuff and we're always willing to pick up the phone and talk through anything. With that said, we have Ed Berman here as the head of risk to do the risk presentation. So I'm going to ask Ed to come to the table. And I just want to also remind the board, you don't just have BAM's expertise, you also have NEPCs too. Give you guys a little plug down there. And they're also around to answer questions.
Hello. This one. Okay, sorry about that. And good morning. So if I would summarize everything we're trying to do is to deliver the best risk-adjusted returns. And returns are somewhat easier to visualize, and Steve just did a wonderful job walking you through the returns for the quarter. The risks are somewhat more difficult. And intuitively, we'll understand what risks are, but quantifying risks can be quite challenging. Your portfolio, you have about 20 billion in assets, investing in all major asset classes globally. You have 65 public managers, about 340 private funds. So if you think about number of people who touching your portfolio, making decisions, it's in thousands. Think about the markets globally. Altogether, that may risks. And for the purpose of this conversation, I'll define risks in terms of the expected performance. And much like we talk about two measures of performance, we talk about total return and we talk about excess returns. We think about risks in the context of total risk, meaning the expected performance of your portfolio for the next 12 months. And we think in terms of what we call active risk. That's the expected performance of your managers, the expected excess return of your portfolio. But obviously your portfolio is long only. So the main impact, the main factor that goes into risk is market. So let me put it in the context. Can we have the next page, please? And when you talk about markets, they're really just two items that you need to keep in mind, two factors you need to understand. The first one is the volatility. What I mean by this is how the price of the markets go up and down. And if you look at these charts on the screen, first of all, consider the volatility of equity markets, which we measure by the VIX index. It's the volatility of the S&P. And the way this chart is presented, it shows the typical range of the VIX for the last several years. You can see that by fine beyond over the last 5 quarters, volatility of the markets have normalized. Where we started about a year ago in about mid-range, now we're clearly fairly low in volatility. This is normal market environment, risks came down. Chart number 2 on the right-hand side, you're looking at the fixed income volatility as measured by the MOVE index. Here you see a very different picture. Here clearly the volatility of fixed income markets is probably best described as in the mid-range. And that's really just a reflection of how unique the recent markets are. I'm not going to reiterate the story of the past few years, COVID, inflation, but we're truly in a unique environment. And you can see that this quarter, if anything, volatility ticked up slightly. So we're still not out of the woods and the risk is still high. The second item you need to keep in mind, talking about risks. Have the next page, please. Thank you. Is what we call stock bond correlation. And what I mean by this is simply how do stocks and bonds move relative to each other. And the assumption that explicitly made when building your portfolio is the negative stock bond correlation, meaning when equity price move up, bond prices move down. It's not just your portfolio. I would say probably all portfolios, all pension systems globally have this assumption baked in. And why is that? But simply, if you look at chart number 1, it shows you stock bond correlation for the past 25 years. 20 years. And you can see that except for the recent period, the stock bond correlation tends to be negative, meaning that bonds act as a natural hedge for your equity portfolio. Why is it positive as of recently? The short answer is inflation. See, if you look at the right chart number 2 on the right-hand side, where we show the inflationary trends over the past 20 years, we can break up the world into 3 regimes. Before the global financial crisis, when inflation stayed about 3%, and you see the stock bond correlation was about 0.25, followed by the post-crisis environment when inflation stayed low globally, when the Federal Reserve accepted the formal inflation targeting program, inflation stayed about 2%, and the stock bond correlation moved down close to 0.4, minus 0.4, followed by the recent environment of high inflation, obviously stock bond correlation down. So that seems to be like a low explanation. Unfortunately, the picture is somewhat more complicated. So.
Out of curiosity, I'm sorry to interrupt. Do you believe that with the rise in interest rates that we're going to get back to a historical negative correlation? Or do you think we're going to, is there anything that we're not seeing that would keep bonds and stocks moving in the same direction at the same time?
Yes, that's about to go into this question, exactly. So it's not just the inflation or interest rates. So if you look at the page on the next page, okay, can I have the next page, please? So here we look at the stock bond correlation since the beginning of the 20th century. And the first thing that jumps at you is that the picture is very different. First of all, in the 20th century, if anything, the stock bond correlation tends to be positive. You'll find the periods of high inflation, like after the Second World War, after the Korean War, and in the high inflation environment, stock bond correlation was actually negative, which is different from what I just told. So what drives it? And the answer is actually more uncertainty. It's not the level of interest rates, it's not the inflation, it's the uncertainty and expectations about the inflation and the GDP growth that drives stock bond correlation. So what changed in the 21st century after the year 2000? It's mostly the appearance of the activist central bank policy, the Federal Reserve of the United States, the European Central Bank, and other central banks, in creating an environment of low volatility. Some people call it financial repression. And that's what created this environment of negative stock bond correlation, which we fully expect to return. As inflation normalizes, interest rates will come down, the central bank policy stays the same. We expect the correlation to come down. Why is it important to watch it? Just to give an idea of stock bond correlation moving from minus 0.5 to plus 0.5, well within the range, the risks of your portfolio will change by about 20%. Meaning to realize the same level of risk, we would need to cut the equity exposure, meaning lower returns. So it's not some academic exercise, it's something to watch very closely. And in an environment of high stock bond correlation, your portfolio may perform differently, and the role of fixed income needs to be thought. There are parts of your portfolio explicitly designed to address this, particularly hedge funds. It's one of it. The private assets, private equity, infrastructure, private credit, valued with a delay, that uncorrelated from public markets, it creates a very healthy dose of diversification that addresses stock. So how all of this feeds into your portfolio? Let's just talk about your portfolio and the risks. Okay, the next page, please. Thank you. And the risk for your portfolio at the end of the fourth quarter stood at 10.8%. You see this number in the lower right corner of the table. And again, what I mean by this is the expected total return for your portfolio over the next 12 months will be in the range of 10.8%. Is it a good number, a bad number? Should you worry about this number? To put it in the context, let's start with the broad market perspective. We start with column one. It's the same discussion we had the previous quarter. Thinking about the market portfolio, broad blend of 65% MSCI ACWI, which is all country index, is the broadest measure of equities, and 35% of Bloomberg US Aggregate Index, which is the broadest measure of domestic fixed income. You can see that the total risk of this portfolio at the end of the fourth quarter stood at 11.1%. Just keep this number in mind. This is your market. This is your market environment. The policy, strategic policy benchmark, which introduces the 11 asset class of your portfolio. The risk of the benchmark is 10.1%. It's actually lower than the market. And there are two reasons for it. First of all, it's the result of diversification coming from the asset allocation. It's a positive outcome. It's also a result of several lower risk asset classes introduced to your portfolio by asset allocation, such as hedge funds, infrastructure, and real estate. And moving from your benchmark to your portfolio, you can see that the risks at 10.8%. First of all, they're well aligned with the market. Your portfolio is also well aligned with the benchmark, which is an important conclusion. You can also see from this analysis that the returns of your portfolio are mostly driven by the markets, which is not surprising given that it's a long-only portfolio. And finally, the second measure of risks, we have to measure performance, local excess return, we have to measure of risk. The active risk, which is forecast of the excess return, so that 1.8%. You see this number again at the lower right corner of the page. We'll talk more about it, about the components and the drivers of this return. But before we flip page, I just want to draw attention to the charts on the right-hand side of the page, where we show the historical evolution of these risk measures and the relation between these three portfolios. starting with chart number 1, you can see that all three portfolios, the market, the benchmark, and your portfolio itself, the risks are trending down over the past year, again, consistent with the trends I showed you earlier in the VIX and MOVE index. And we see that the relation between this between these portfolios stays about the same. So nothing unexpected for this quarter. It's a good outcome. And finally, chart number 2, when we show the evolution of active risk, which is the forecast of excess return, again, it stays fairly steady, trending down slightly in line with market. So no big surprises. So this page gives you like the highest kind of check on your portfolio, gives you a sense of confidence at the highest vantage point. So let's just dive into these numbers. The next page. So as I mentioned, the total risk for your portfolio, the expected total return, stands at 10.8%. So what makes this number? Here we show you 2 pictures of AS allocation. On the left-hand side, this is your, this point, old asset allocation. We're still in the fourth quarter. And I hope that's a picture everybody recognizes. It's well familiar between public equity, public fixed income, and alts. These are the verticals that define your strategic asset allocation. On the right-hand side, you see what we call the risk allocation. This is the breakdown of total risk in your portfolio. This is actually how your portfolio performs in reality. And this is so because equities is by far the most volatile asset class. It's also the asset class that gives you the most return. So you can see on the slide that 65% of risks and 65% of returns are driven by public equity. And I think we spend much more time talking about private asset classes, and I think we're talking with Steve. We probably need to pay more attention, bring to the boards more details about the public asset classes, because this is what really determines your portfolio. Now you can see that the returns of your portfolio are not necessarily 65% public equity. And this is true. And this is the result of rebalancing. And that highlights why rebalancing is so important. It's one of the most critical components of your portfolio. Something to do at least weekly. If we left your portfolio alone, that's how it would look like in about a year. And I keep saying that risk and return are closely connected. So it's important to measure the forecasted risk against the realized returns. Can you give it the next page, please? Thank you. And this is really a check on your strategic asset allocation. So clearly we do asset allocation once every 3 to 5 years, but it's not something we leave alone. We watch it behind the scenes, and here we talk about it. And here we show you, starting with chart number 1, which is the highest breakdown of your portfolio. The vertical bars represents the risk forecast or the expectation of returns. And the triangles show the realized outcome, the realized total return for this quarter. So you can see that your portfolio, leftmost bar of the chart, the returns slightly exceed the forecast, and it's clearly driven by the public asset classes. Both equity and fixed income delivered the returns well in excess of the expectation. You can see chart number 2, public equities, US equity, developed ex-US or developed markets, well in excess of expectation. Fixed income, same thing. And this is really, if you think about the narrative in the market in the 3rd quarter, 4th quarter, and even now, we started with essentially 100% certainty of a recession. That's how we started year 2003. It was followed by the hope for soft landing. It's probably commonly expected that we are in a soft landing, and now we're probably expecting the takeoff after landing. The markets exceeded the expectation on all fronts. So equities performed well ahead of expectation. Rates rallied. The 10-year went from 4.6% to 3.8%. Massive rally in 1 quarter. Credit spreads essentially collapsed. The high yield spread went from 480 to 350 basis points. Huge rally. So you can see that the total return went in excess of expectation. But please keep this message in mind when we talk about manager returns. Well, humans will also up into the narratives. But overall, it's a healthy outcome, and if anything, I hope it will continue. So we talked about total risks and total returns. Let's talk about the excess returns. The next page, please. So the excess returns come from your managers. And that's another important component when we talk about the risks. What we show here is the breakdown of your active risk. We just thought that active risk in your portfolio runs at 1.8%, meaning we expect the excess return from managers to be about 1.8%. Here we show you the trends and the breakdowns for the past year. And you can see that the vast majority of this active risk comes from private assets. So it's private equity, infrastructure, real estate drives the majority of active risks. You can see that public equities contribute about 20 basis points to this, and public fixed income contributed about 5 basis points. And I would say one of the ongoing active projects within BAM is we're trying to understand these exposures better and see if we can do a better job in manager selection and building portfolio. It's something we'll talk to you in the next few quarters. So how did these risks connect with the performance? Give the next page, please. And again, it's important to talk about risk versus performance. This is a check on your managers. If something happening, something unusual happening to the managers, that's where it will pop up. So again, starting with chart number 1, when we look at the excess returns and excess risk for your portfolio, you can see that essentially everything performed well within expectations. Your portfolio, which is leftmost bar here, performance aligned with the expectation, check. Equities, broadly speaking, aligned well. The only area we see slight misalignment is fixed income. And I'll draw attention to chart number 4 at the bottom right corner of this page. And you can see that all verticals within fixed income, core fixed income, tips, and mostly high yield underperform. And we also have Robert here behind me who can talk in much more details about it. But just to make a comment, remember we're talking about total risk, mentioned that economy and markets well exceed expectations. That's where you see it. Your managers were expecting a different outcome. So they positioned more defensively, both in terms of their maturity, in terms of the exposure to high yield, and they under. Again, results for one quarter, we're not drawing conclusions, but it's something we watch very carefully behind the scenes. So we talked about the outcome so far, but of course, no risk discussion won't be complete without talking about the future. We have basically challenged the future is unpredictable and unknowable, but we can make a guess. Next page. So we don't know where the next shock will come from, what it will be, or will it occur. But chances are the next shock will be either in the area of equities, rates, or commodities. And your portfolio doesn't invest in commodities. Commodities is a life stream of the economy. We cannot escape. In here, for each of these 3 buckets, we identified 3 main markets, like the S&P, the Euro Stocks, and MSCI EM for equities, for example. And we asked our risk system, what would be the worst monthly outcome over the next 12 months? And that's what you see on the screen. And I'm not going to read you this page. It's a lot of numbers, but we show you the potential envelope of uncertainty, potential outcomes. And you can see that the range is very wide. Like for example, chart number 1, the S&P, you can see that when we prepared this chart, the S&P was still at 4,900. As of right now, it stands at 5,100. But our system sees a chance of going over 6,000, well below 4. It's a wide range. Or consider chart number 9, when we look at inflation, and clearly inflation is a story. It's happening currently with us. Inflation came down significantly to 3.1 when we put this chart. Actually ticked up slightly to 3.2. But it's important to say that nobody knows the future, and Steve just mentioned Larry Summers, who calls for a hike for the Federal Reserve. Our system says that inflation can go up 5.6%, can decline almost a deflation environment. We don't know. So it's important to see how your portfolio will perform in this broad range of uncertainty. We see the results on the next page. Thank you. So here we show the same 9 markets, 9 shocks. And the important thing to emphasize here, the way we constructed the shocks, they're all equally probable. So our system consists in equal probability for a 23% shock to the S&P as a 24% shock for MSCI emerging markets, meaning emerging markets are some more risk than bond. So when you look at this, you can just compare the results, how your portfolio performs. You can see where the biggest shocks and biggest risks are. So look in column number 1 on the absolute returns. You can see that the biggest risk for your portfolio is the S&P 500 US markets. That's not surprising at all. This is your largest allocation, about 30% of your allocation is S&P. What's maybe more surprising that the emerging market shock will result in a 12% loss. Emerging market is not a large allocation for your portfolio, but it's still a significant exposure. In the rates area, we talk about Federal Reserve, which mostly influences the 2-year Treasury. Your portfolio is not that sensitive to the Federal Reserve rates. What it's sensitive to mostly is the euro-dollar exchange rate. So when dollar depreciates, your portfolio will gain. And lastly, in the commodities, it's the copper that drives most of your exposure. Less than, not inflation so much, not oil, it's copper. And why copper is important? Everything being produced in the world requires copper. It's computers, it's wind turbines, it's cars, everything needs copper. So bring it all together. If you look at this table, you're sensitive to the S&P 500. You're sensitive to the euro-dollar exchange rate. You're sensitive to the copper prices. Bring it all together. Your portfolio is driven by the GDP growth, by the global GDP growth. It's positioned pro-growth. And the last point I want to make, unless a question to go to the next page, we also watch the changes. Over the next page. Thank you. Also watches the changes in your stress exposures. And the way you read this chart, these numbers are negative, meaning we call it a stress loss. So moving closer to 0 means less exposure. And you can see that almost all lines tend to trend higher. Moving close to 0, meaning the risks on your portfolios decline. And this is consistent with the message I told you earlier about the drop in the equity volatility, steady fixed income volatility, and a slight improvement in stock-bond correlation. There's one outlier in this chart. If you see in the middle, the 10-year Treasury moved towards a higher level. The risks increase because against the trend. And what drives it? It's the shape of the curve. So going back to Steve's presentation, he was talking about the inverted yield curve. It actually became more inverted during the 4th quarter. And the risk to your portfolio increased. And I just want to highlight this because it's not something we talk about very often. It may seem like a bit of an academic question, inverted yield curve, because your consequence for your portfolio, and actually that part increase these exposures. So I'll stop here for any questions. Any comments?
Can I just make a quick comment on one of the points you made? When it comes to and I know, I apologize for being late. I know that you went through the performance of the portfolio, and last year, primary drivers of the underperformance were the U.S. equity allocation and high yield. And when it comes to high yield, I just wanted to make the point that the 4th quarter was a very unique environment where, the market was anticipating what the Fed is going to do or what they think the Fed was going to do based on one meeting and the conversation around that. And your managers underperformed in that quarter, but your managers collectively have done very well over the 3 and 5 year periods, and some of them have been in place for much longer than that. And high yield is actually a category where typically active management has been tough to add much more than 20 or 30 basis points over fees without having either a very concentrated portfolio or a portfolio that's very different than the universe. And you have multiple managers, and they've protected very well in 2022 down market cycle. And that's been driving kind of your portfolio outcomes for the last, 5-year cycle. And so we view the fourth quarter as just a little bit of a blip in terms of active management. And we think that, all the managers are doing a great job over the long term. You don't have any that are underperforming over the 3 and 5 year period. So even though it's a portfolio of multiple managers, I think it's 6, they're all doing well. There aren't like a barbell there. So just wanted to make that point. Thanks.
Okay, any other questions? Okay. All right, hearing none, I believe that concludes the formal remarks. I just want to say, yesterday was St. Patrick's Day, tomorrow's St. Joseph's Day, so this is kind of the middle day for a lot of us. So we're going to try to get through this next part of the meeting in a quick period. That's what we get. Yeah. So with that, we'll make a motion to exit public session and enter into executive session.
Second.
Any opposed? Hearing none, the motion carries. Please turn off the recording.
Please.
Entering into public session, and we are actually starting with a firefighter variable supplements fund meeting. So we will
For the mayor's office,
Kevin Liu, present.
controller's office,
John Dorsett, designee for control, Brad Lander.
and Mr. Eustace for Mr. Ansbro.
Present.
Mr. Eustace,
Present.
we have a quorum.
So I would like to note the receipt of the quarterly report for the firefighters variable supplement fund.
thank you. We now need a motion to adjourn this meeting and start the fire officers variable supplements fund.
So I'll make a motion to exit the firefighters variable supplement fund and enter into the fire officers variable supplement fund.
Second. Bob Eustace.
Okay. Thank you. So we are now in the fire officers.
Excellent. And I will give over to Mr. Dunn for a roll call.
Okay, for the mayor,
Kevin Liu, present.
for the controller,
John Dorsett, designee for control, Brad Lander.
and for the UFOA, Mr. Guilfoyle. Here. And Mr. Camastro.
Present.
We have a quorum.
So Commissioner, I'd like to note receipt of the fire officers variable supplement fund quarterly report and take any questions. If there are none, then I'll make a motion to exit and enter the public session of the fire pension fund.
Motion.
Second, any opposed? Hearing none, the motion carries. We're now resuming the fire pension fund meeting. During executive session, the board discussed various investment matters. There's nothing further on our, I would welcome a motion to adjourn.
Motion to adjourn.
Second. Lee Guilfoyle.
Any opposed? Hearing none, the motion carries. We are adjourned. Thank you all.
Thank you all. And if Bam could shut the camera.